So when you think about a mortgage, you're usually looking at, what, two things, right?
The interest rate.
The interest rate and maybe some admin fees. It's a pretty standard package.
A two-part tariff, yeah.
But what if the insulation in your walls or the efficiency of your boiler wasn't just about saving on your heating bill?
What if it actually changed the price of the loan itself?
Exactly. And that's what we're digging into today. There's a brand new staff working paper from the Bank of England just published yesterday.
January 16th, 2026. It's called Product Innovation in the UK Mortgage Market.
Right.
The case of green mortgages.
Right. By Mahmoud Fatou, Benjamin Ginn, and Halik Unal.
And their work really gets to the heart of how something like energy efficiency went from being this, nice-to-have feature.
To a real financial lever. It's fascinating.
It is.
They frame it as product innovation, which is a bit strange for a bank, isn't it? I mean, they're not manufacturing widgets or rolling out a new phone.
No, and that's the core idea here. The authors say you should think of a mortgage as a structured bundle of attributes.
A bundle of attributes.
For decades, that bundle's been really simple. You had the rate, the fee, the term. That was basically it.
And innovation only happens when a new attribute gets added to that bundle.
And becomes pricing relevant, so it actually affects the cost.
And in this case, that new attribute is the Energy Performance Certificate, the EPC.
Exactly. It moves from being just, a piece of paperwork you have to file.
Just a box to tick.
To a variable that genuinely changes the numbers on the loan.
And the data shows this shift was incredibly sudden. The authors pinpoint, a single moment where everything changed.
They do. It was 2018. They matched all this EPC data to mortgage records and found this stark divide.
So before 2018.
A great EPC rating meant nothing for your loan terms. It was irrelevant.
And after 2018.
Lenders started actively, offering discounts for more energy-efficient properties.
And these weren't just token discounts, were they? We're talking about real numbers.
Oh, absolutely. They looked at the actual offer level data, and by 2022, these green discounts had reached up to 15 basis points.
Okay, so just to put that in perspective for everyone, 15 basis points is 0.15%. On a huge loan over, say, 30 years, that is not pennies. That's a serious amount of money.
It's a tangible saving. But the paper also notes the distribution is a bit skewed.
How so?
These mortgages are heavily concentrated in new build properties.
Which makes sense. It's obviously much easier to hit those high EPC ratings with a brand new building than, say, trying to retrofit a drafty Victorian house.
It does, yeah. But the authors argue that even with that concentration, there's a net positive economic effect.
A ripple effect.
Right. They call it relaxing credit constraints.
So basically, by making the money cheaper for these specific homes, banks are encouraging investment that might not have happened otherwise.
You've got it. It stimulates that part of the housing economy, and it proves their whole theory.
That the bundle of attributes has officially expanded.
Yes. Information that used to live completely outside the financial contract, like how warm your house is now priced inside the contract.
It's a fundamental change to the product itself. The physical asset is now driving the cost of the financing.
A pretty big evolution.
So it leaves you with a pretty big question then. If the bank is now pricing your loan based on your wall insulation to the tune of 15 basis points, and that door to non-financial attributes is now open, what else might come through it?
That is the big question.
I mean, could your commute time be priced in next? Maybe your personal health data? Once you start expanding that bundle of attributes.
It's hard to know where it stops.
A lot to think about. Thanks for diving in with us.